You're doing it right now, and you don't even know it. You're making a decision with your money that will cost you more than you can afford to lose. Not tomorrow, not next month, but the cost is already being calculated. The damage is already accumulating. And by the time you realize what's happening, it'll be too late to fix it. I've been investing for 40 years. I've seen fortunes built. I've seen them destroyed. I've watched people make the same mistakes over and over again. Smart people, educated people, people just like you. And the worst part, they all thought they were doing the right thing. Here's what separates the wealthy from everyone else. They don't make emotional decisions with their money, but you are. Right now, someone is making a financial choice based on what they saw on social media this morning. Someone is moving money into an investment because their friend made money last year. Someone is keeping cash in a savings account earning nothing while inflation eats their wealth. Someone is staying out of the market because they're afraid. Someone else is all in because they're greedy. All of them are wrong. And if you keep doing what you're doing, you will be too. So before you click away, you need to understand what's actually happening with your money. Because 2025 is not 2024. The rules have changed. The risks are different. And the people who don't adjust will pay a price. Well, let me be clear. I'm not here to motivate you. I'm not here to pump you up. I'm here to tell you the truth, whether it's comfortable or not. If you want comfortable, watch something else. But if you want to actually protect your wealth and build it systematically, stay with me. Here's what most people get wrong about money management. First, they treat saving like it's the same as investing. This is the most expensive mistake I see. People will put money in a savings account, congratulate themselves for being disciplined, and then wonder why they're not building wealth. They think saving and investing are the same thing. They're not. Not even close. Saving is safety. It's shelter. You put money in a savings account because you need it accessible and protected. Fine, that's one tool. But investing is growth. It's capital deployment. It's putting money to work in assets that generate returns above inflation. Here's the brutal reality. If you're only saving and not investing, inflation is stealing from you. Right now, in 2025, savings accounts pay between 4 and 5%. Inflation is running around 2.5 to 3%. So you're getting real returns of maybe 1.5 to 2% a year. That's not wealth building. That's slow motion poverty. You think you're safe, but you're actually losing. Meanwhile, the person who invests consistently in diversified assets is compounding at 7, 8, 9% annually. Over 20 years, that difference is catastrophic. We're talking hundreds of thousands of dollars. The wealthy know this. They don't keep excess cash sitting idle. They deploy it. They take calculated risk because they understand that the real risk is doing nothing. You're probably sitting on money right now that you think is safe. It's not. It's eroding. Second, they chase returns instead of building systems. I see this constantly. A stock goes up 200%. Everyone rushes in. A cryptocurrency explodes. Everyone FOMOs in. A sector gets hot. Everyone piles in. And then it crashes, and everyone gets hurt. Here's what you don't understand. The people making money aren't chasing returns. They're executing systems. A system is boring. It's consistent. It's disciplined. You have a plan. You contribute regularly. You rebalance. You don't deviate based on headlines. You don't panic sell when things drop. You don't chase what's hot. The S&P 500 has returned about 10% annually over the long term. Not exciting, not sexy. But if you had invested $10,000 in 1985 and just held it, doing nothing, you'd have over $500,000 today. That's not luck. That's mathematics and patience. But that's boring, so people don't do it. Instead, they look for the home run, the next big thing. The stock that's going to go from $5 to $50. And statistically, most of them never do. The people who actually get rich from those bets are the ones with decades of experience, and even then, they're lucky. For every winner, there are 10 losers. So what do the wealthy do? They use the boring system to build the base. They get wealthy slow. Then, with a small percentage of their capital, they take speculative bets. But their main wealth building isn't in speculation. It's in discipline. You have it backwards. Third, they don't understand the compounding tax on financial mistakes. Here's a scenario. You have $100,000. You make a bad investment decision, you lose 15%, you're down to $85,000. Now, to get back to $100,000, you don't need a 15% gain, you need an 18% gain. That's not math error, that's the cost of the mistake. The bigger the loss, the more disproportionate the recovery needs to be. This is why wealthy people are conservative with capital preservation. They know that losing money hurts exponentially more than making money feels good, but most people treat losses like they're temporary. They think, I'll just wait for it to recover and I'll be even. That's not how it works. And the time you waste waiting is time you could have been compounding your remaining capital in the right direction. Every bad decision compounds against you, not just the immediate loss, but the opportunity cost, the psychology, the hesitation it creates next time. The wealthy understand this. They make fewer mistakes because the cost of mistakes is so clear to them. A 5% error on a $100 million portfolio is $5 million. You start being very careful with decisions when you truly understand the mathematics of loss. You're probably making small mistakes right now that feel insignificant. They're not. They're compounding. Fourth, they confuse activity with progress. You see this in every sector. People who trade constantly, people who check their portfolio every day, people who move money around, adjust positions, try to time the market. They confuse the feeling of doing something with actually moving forward. Here's the truth. The average day trader underperforms the S&P 500 by 3 to 5% annually. Why? Because they're generating transaction costs, paying taxes on short-term gains, and making emotional decisions at the wrong times. The person who buys a diversified portfolio and checks it once a quarter outperforms 85% of professional investors over a 10-year period. Activity is not progress. Discipline is progress. Patience is progress. A clear plan executed consistently is progress. But it doesn't feel good. But people don't do it. The wealthy have already accepted this. They understand that the hardest part of investing isn't picking the right stocks. It's sitting still while everyone else is panicking and moving. You're probably overcomplicating your finances right now. You're probably thinking about it too much, moving money around too much, and making changes too frequently. Every time you do that, you're paying a cost, fees, spreads, taxes, emotional damage. Fifth, they don't have a real plan for their money. This is the foundational mistake. I ask most people, what's your financial plan? And they either can't answer or they give me something vague. A plan isn't vague. A plan is specific. It has numbers. It has timeline. It has clear triggers for action and clear reasons for holding. Here's what a real plan looks like by age 35. I will have 6 months of expenses in liquid savings. By 40, I will have invested enough to generate $10,000 a month in passive income by age 55. By 50, I will be drawing down and transitioning to a capital preservation strategy. That's specific, that's measurable, that's a real plan. Most people have nothing like this. They just exist financially day to day, hoping something good happens, afraid something bad happens, reacting to headlines and hot tips. The wealthy have a plan, and they execute it regardless of market conditions. When the market crashes, they don't deviate. They might actually accelerate contributions because assets are cheaper. When the market booms, they don't get greedy and overallocate. They rebalance. The plan is the thing that saves you from yourself, and you probably don't have one. That's not an accident. That's a choice you're making, and it's costing you. Let me tell you what happens next if you keep doing this. In the next 2 to 3 years, we're going to see market volatility. Real volatility. It might be triggered by geopolitical tension. It might be triggered by credit cycles. It might be triggered by something nobody's predicting. People who don't have a plan will panic. They'll sell at the bottom. They'll lock in losses. They'll miss the recovery. And they'll exit the market angry, swearing never to invest again. People with a plan will see the crash as an opportunity. They'll buy more at lower prices. They'll compound faster. They'll be wealthier on the other side. The difference isn't intelligence, it's discipline. It's a plan. Right now, the market's up, money's flowing, everyone feels smart. This is when you should be defensive and careful, not reckless. You're not as smart as you think you are. The market will test you, and if you're not prepared emotionally and financially, you will fail. So here's how smart money actually thinks about this. First, they accept risk, but they don't accept risk. They accept calculated risk in diversified assets. They know that the safest place to keep wealth long-term isn't in cash. It's in productive assets that generate returns. Second, they focus on what they can control. You can't control market returns. You can't control interest rates. You can't control geopolitical events. What you can control is your savings rate, your investment discipline, your costs, and your behavior. The wealthy obsess over these things. They don't waste energy on what they can't control. Third, they think in decades, not days. This changes everything. When you're thinking about the next quarter, you're emotional. When you're thinking about the next 20 years, you're logical. You make better decisions. Fourth, they automate their discipline. They set up automatic transfers, automatic investments, automatic rebalancing. They remove themselves from the equation because they know their emotions are the enemy. Fifth, they measure progress against their plan, not against headlines. They don't care if the NASDAQ is up or down today. They care if they're on track to hit their financial goals. That's the only metric that matters. This is the mindset shift that changes everything. So here's what you need to do right now. Stop pretending that what you're doing is working. If you don't have a written financial plan with specific numbers and timelines, you don't have a plan. Build one. It doesn't need to be complicated. It needs to be real. Stop checking your portfolio daily. You're just creating anxiety and temptation to make emotional moves. Pick a review schedule quarterly or annually and stick to it. That's it. Stop chasing returns and start building systems. Pick a diversified strategy. Contribute regularly, rebalance annually. Execute it regardless of what's happening in the headlines. Stop keeping excess cash in accounts that are losing to inflation. You need an emergency fund, 3 to 6 months of expenses that sits in cash. Everything above that should be working for you in investments. Stop making emotional decisions. Before you make any move with capital, wait 48 hours. Write down your reason. Ask yourself if you're reacting to fear or following a plan. If it's fear, don't do it. These aren't sexy steps. They don't generate excitement, but they work. And more importantly, they work because they align with how wealth actually builds slowly, systematically, and inexorably over time. The final thing you need to understand is this: time is your most valuable asset right now. You're sitting here thinking you have time to make up for mistakes. You don't. Every year you waste is a year of compounding you lost. That's compound interest in reverse. It's compounding against you. Someone who starts investing at 25 and invests $20,000 a year until 65 will have nearly $4 million, assuming 8% average annual returns. Someone who starts at 35 and invests the same amount for 30 years will have about $2.4 million. That's nearly $2 million less for only starting 10 years later. Time is not your friend if you're not using it. It's your enemy. So stop wasting it. Stop delaying. Stop making excuses. Stop assuming you'll figure this out later. Later is now. If this resonates with you, hit like. The algorithm notices. It sends this to people who are serious about their money, not people who are just casually scrolling. Do comment below. What's the biggest financial mistake you're making right now? Be honest. Name it, because naming it is the first step to fixing it. Subscribe if you actually care about building wealth systematically. This channel isn't for people looking for hot tips or quick money. It's for people willing to do the boring, disciplined work that actually builds generational wealth. If that's you, subscribe. It's a filter. We keep people serious. We keep people focused. For those of you ready to go deeper into financial strategy and personal accountability, membership is available. It's for investors who are done wasting time and ready to accelerate their path to financial independence. Link in description, but most importantly, start today. Not tomorrow, not next month, today, because the cost of waiting is a cost you'll never get back. Money doesn't care what you believe. It only responds to discipline.